Hello everyone. Today I want to shed light on the crucial topic of banking reforms in India, as discussed in Aravind Panagria's book, India the Emerging Giant. The banking sector has always been a cornerstone of India's economic framework, but it faced a significant challenge in the past, which necessitated a wave of reform to strengthen the system. In the early years, Indian banks were predominantly owned by private entities, but the concern over their practices and accessibility to rural areas led to a widespread nationalization in the late 1960s and in early 1980s. The rationale was to ensure the banking services reached the underserved and to drive economic growth. However, this state-controlled approach brought a inefficiency including overstaffing, poor management and excessive government intervention. Public sector banks suffered from low profitability and rising non-performing assets, while the private bank faced regulatory constraints that stifled competition. The real need for change became apparently in the early 1990s when India faced a severe balance of payment crisis. This was a wake-up call leading to a series of economic reforms, with bank being a critical area of focus. The government formed a Narashimam Committee, which was tasked with diagnosing the banking sector problem and suggesting reforms. The committee recommendation set the stage for a significant overhaul. The key recommendation included recording the statutory liquidity ratio (SLR) and the cash reserve ratio (CRR) to allow banks for more freedom in their leading activities, thereby increasing credit flow to the private sector. The committee also advocated for reduction of NPAs by instituting sticker loan recovery laws and improving the transparency and accountability in banking operations. Furthermore, the reform agenda emphasized the need for entry of a new private sector banks and foreign banks to foster competition. This introduced a breath of fresh air into the system by bringing in new practices, technology, and management styles. The liberalization also extended to allowing Indian bank to tap into international market for capital, thereby integrating more closely with global financial systems. Significant steps were taken towards improving the functioning of sector banks. The government introduced measures to enhance their autonomy, allowing banks to make commercial decisions independently, such as setting interest rate and choose where to open branches. However, these banks continue to grapple with a legacy issue of NPAs and government interference in decision making. To address the growing concern around NPA, a comprehensive legal framework was established, including uh, enactment of Securitization and Reconstruction Financial Asset and Enforcement of Security Interest Act, SARFASI Act in 2002. This provided banks with greater authority to seize and liquidate asset of defaulters, thereby enhancing the recovery process. The reform brought undeniable improvement. The bank sector became more resilient, saw better profitability, and was better able to support India's economic growth. The sector has since evolved into a blend of public and private players, with both entities leveraging technology to offer innovative services. The transformation also made India Bank more competitive globally. However, challenges remain. Despite these reforms, public sector banks still hold a significant share of banking market, which bring back concern about efficiency and profitability. The government's continue stake in this bank create a complex scenario where market-oriented practices are still evolving. In conclusion, while banking reforms in India have significantly modernized the sector and made it more robust, there is a still need for continued reform, particularly in enhancing the efficiency of public sector bank and ensuring sustainable financial inclusion. The journey of banking reform in India reflects a broader story of economic liberalization, moving from a state-controlled approach to a more market-driven framework. Thank you.